Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I hope that you all have a great, restful weekend. And before we start our Daily Dose of Market Insights today, which is pretty much of a critical juncture now for global markets, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay. Okay, so before we start, let me do a check again. I hope that the voice and the so-called the slides are all good, are showing on your screen. Just to give me 1 minute of a check. Okay, good, excellent. Okay, so now, like I mentioned earlier, today's daily dose will be pretty much crucial for the global markets of what has taken shape on last Friday and even the entire whole of last week. So now, very important, I'll highlight the key events that took shape on last Friday, and as well, I will share with you all its impact in terms of the intermarket dynamics and from a fundamental medium-term perspective. Then we'll sum up for today's intraday technical outlook we'll share with you all, and as well as other key events and data to look out for today that could impact its intraday movement as well. So let's start with what has taken shape on last Friday. So on last Friday, we have the release of that non-farm payroll data. So still recall that for those who joined my daily dose last week, I did mention that if the non-farm payroll data starts to show very weak numbers, it increases the risk of a hard landing or a recession scenario that has already taken shape that may be in motion in the US economy. It could actually negate that bull steepening scenario, which by right at the initial stage should start to see positive outperformance of the Dow Jones Industrial Average and the Russell 2000 for them to take the front seat of the high-flying Nasdaq 100 and the S&P 500, which has been driven since 2 years ago and even the start of this year by mega cap technology stock on the coattails of AI optimism. But however, because of the disappointing non-farm payrolls data that took shape on last Friday, this particular positive impact of that bull steepening towards Dow Jones Industrial Average and the Russell 2000 more or less will be evaporated. Later I'll talk more about that. Okay, so now let us now straight away jump straight to what is the number of the non-farm payroll data. So if you look at the non-farm payroll data right now, what we could see is that the number came in a very horrendous number. So market is expecting 175K, but what it came in over here is only 114K. And last month figure was actually revised downwards from 206K to 179K. So if you look at the number of jobs added based on the trend, it clearly takes us down to way below 200K level. All right, so this is the weakest level if you look at the from a 5-year horizon, 114K. So this is the weakest level, right, since almost during the December 2020 slide over here. Okay, so then if you were to look at the unemployment rate, it also surprisingly tick up much higher as well to 4.3% from 4.1% that was printed in the month of June. So net overall, what we could see over here is that we start to see a huge incremental increase in the unemployment rate. So you look at the unemployment rate right now, it's slowly inching up higher, and immediately it tells us a sign that the US labor market is not in a rosy scenario. That means, i.e., perhaps the risk has started to increase of a potential hard landing or a recessionary scenario that could in fact starts to unfold at this juncture. So we know that the only thing that recession starts to show up in any particular economy, we got to wait for the GDP data to start to show 2 consecutive quarter of negative growth. So by the time this 2 quarter of negative growth starts to show in the press, or in fact start to materialize, the economy has really starts to weaken by a fair bit. But there are some signs that could tell us ahead of time, like ISM manufacturing PMI data, ISM services manufacturing PMI data, or any form of PMI data that has a leading element in the economy. And also consumer confidence in the US economy that has already starts to turn weak, like I shared with you all in a couple of weeks ago. So now more and more other form of economic data is now pointing to a hard landing scenario in the US. So because of this, it actually causes a correction in the major US stock indices, which tends to also trigger off a risk-off scenario as well. So you could see across the board sell-off in the major US stock indices on last Friday, where the SPX is down negative 1.84%, the Nasdaq is down negative 3.8%, the Dow Jones is down negative 5.51%, down 1.51%, pardon me, and the Russell 2000 is the worst, down negative 3.52%. Net overall, even though right now, later I'll share with you all, the US Treasury yield curve is doing a bull steepening phase, where the 2-year Treasury yield is dropping at a faster pace than the 10-year. Because of this hard landing or recession scenario is getting more and more getting traction in the US economy. This bull curve, US Treasury bull curve steepening, its positive impact is now being evaporated on the Dow Jones Industrial Average and the Russell 2000, as earlier emphasized earlier on, or anticipate earlier on, because it tells us that the US economy is not in good shape, and perhaps very high likelihood is already in a recession scenario. The Fed is being late in the game again, and we know that the Russell 2000 is pretty much have a much more weaker balance sheet than compares to company in the Nasdaq 100 and the SPX 500. So that actually explains its underperformance on last Friday. All right. So now this is the current scenario right now, and if we look at this US horrendous, no, sorry, that US, we call it across the board sell-off that being seen on last Friday in the major US stock indices, it triggered a global risk-off scenario, pardon me, it triggered a global risk-off scenario, which not only impact in the US market, it also starts to spread into the rest of the world as well. So we look at it, the Nikkei 225 continues to tumble. So now it's almost down negative 4.6%. And this level of the Nikkei 225 is back to where we are almost a year ago. During the around now, it's traded at the level at June 2023 level. So almost eradicate the last 4 to 5 months of push up. And we see the Hang Seng Index, surprisingly, it actually also down, but down less than a fair bit. So this is pretty much self-explanatory. Why? Because we know that the China and the Hang Seng stock indices, or the China CSI 300, has been underperforming the rest of the world since 1.5 years ago, and in fact today's current year to date as well. So given that, yes, we may start to see a global risk-off scenario, the Hang Seng continues to fall, they can't rally it, but they fall at a slower pace because of their current underperformance that has been persistent since about 2 years back, and is ongoing right now. And also, if you look at other Asia indices like the Australia ASX 200, the STI, the other Southeast Asia benchmark indices like the KL the KLCI, we call it the Thailand, we call it SET, Indonesia, all of them actually down negative 2% to almost 1% as well. And even the Kospi is down negative 6%, and the Taiwan is down negative 6%. Because these two are currently underperforming because of their highly concentrated component stock in the technology related space, which is semiconductor, that is also linked to the AI optimism that has been taken shape since the start of this year. And right now, what we are seeing right now is the we call it the earlier optimism that is being kind of eradicated, or a kind of a frothy market that's being corrected at this juncture. Okay, so now this is the current situation that is taking shape right now in the market in terms of the news and event flow, and how does it impact the FX market. So we know that across the board sell off in the global benchmark stock indices, depending on where you look at it. Even the Hang Seng, the China CSI 300, they also fell, but don't fell a fair bit as compared to the rest of the world, because they have been underperforming against the rest of the world since 2 years ago. Then how about the FX market? So the FX market will be pretty interesting phase. So if you look at the 5-day rolling performance as of now, we start to see this K-shaped performance again. That means the dollar is actually underperforming against the Swiss franc and the the yen, because these are traditional safe haven currency. So in terms of a major global risk off event that's taking shape, which is taking shape right now, the dollar tends to be weakened against the weakest against the Swiss franc and the dollar yen, and the dollar yen also being supported fundamentally as well. Later when I share with you the fundamentals of the dollar yen. Okay, and but the dollar continues to remain resilient against high beta currency that is very much in sync with risk on and risk off scenario. So we know that the Aussie, the Kiwi, and the CAD, those are commodities related currency. So Aussie is more or less related to copper and iron ore, and the CAD is related to the oil. So we know that in a risk off scenario, commodities like iron ore, copper, and oil will get hit as well. So that actually explains to us why this commodity related currency, the dollar, remains resilient against them. Whereas we start to see the dollar, in fact, even the dollar now also weakening against the euro, the Swiss franc, the Sing dollar, and as well as the CNH as well, due to the plunge in the US 2-year and 10-year treasury yield on last Friday by a significant amount. Okay, so that is the current fundamental, we call it not fundamental news flow that took shape on last Friday, and its impact on the global markets. And with that, also right now, gold also managed to actually be one of the top asset, one of the asset that's actually outperforming in this, we call it a juncture of global risk of scenario, together with, for sure, with bonds as well, because of the push up in the US, push down in the US Treasury yield, and we see US Treasury bond picking up. Okay, because yield and bond, they actually do an inverse relationship. Okay, so now with that, let me touch on the medium term and the fundamentals and its intermarket dynamics, which is very important right now, because that will actually impact the multi-week to multi-month perspective. All right, so now we know that in this scenario over here, the US 10-year treasury yield and the 2-year treasury yield, both of them tumbled. All right, it tumbled. So this is a 10-year treasury yield. So on last Friday, it went down a fair bit by this black Marubozu daily candlestick, and broke below the 28th of December medium-term swing low. So it broke below this level, and right now, if you look at from a multi-week perspective, it seems to be heading towards 3.3%, which is a long-term pivotal support level. That's the 4th of May 2023 swing low area. So what we could see over here is that this is represent a rather weak US economic growth situation. But last Friday pushed down in the US 10-year treasury yield. So for those who recall, the US 10-year treasury yield is a proxy of inflation growth and economic growth. All right, so right now what we're seeing over here is that previously the 10-year treasury is going up. That's during May 2023 to October 2023. So at that point in time, market were talking about either inflationary risk or stagflationary risk coming back into the US economy. But right now, what we are seeing right now in the US 10-year treasury that's plumbing now, it seems to us that market is now fearing deflationary risk scenario. Okay, but the fall in the 10-year US treasury yield is not so pronounced as the 2-year treasury yield. So you look at the 2-year treasury yield, it fall more dramatic, and very clearly it's taken out the December and January 2024, this swing low area over here by a fair bit. So if you look at the 10-year treasury yield, it's only just broken out on last Friday. Okay, so you go back to the 2-year over here, and right now it's now coming very close to the March, April, and May 2023 long-term pivotal support area at 3.63%. So also indicating to us that the Fed is now being led in the game, and now market is now expecting the Fed to actually cut more. Now market is not concerned about when the Fed will cut, is how much will the Fed will cut going forward, given the risk of a potential recessionary or hard landing scenario in the US economy may be already in the motion, as actually being shown by the non-farm payroll data on last Friday. Okay, so now with that in mind, if you look at the CME Fed Watch 2 pricing right now. Okay, so this CME Fed Watch 2 pricing, what we could see over here, very interestingly, previously we are only talking about one interest rate cut of 25 basis point to bring it down to 5% to 5.25%. So currently, right, the Fed funds rate is at 5.25% to 5% current. So how do we know that? If you go back to the current one, it will tell you the current rate is 5.25% to 5.5%. So if you go down to the probability, the aggregated probability over here, okay, what we could see right at the bottom of this table. So now market is now expecting a 73.5% chance of a cut of 50 basis point now. So now market is now looking at a panic cut by the Fed by 50 basis point to bring it down to 4.75% to 5%, instead of the usual high probability odds of only 25 basis point in the September meeting. And after the September meeting, market also pricing a rather high odds right now of another 50 basis point. So right now it's split between 4.5%. That means after a 50 basis point cut, there will be a 25 basis point cut to bring it down to 4.5% to 4.75%, or quite a high chance of 46 basis point of another 50 basis point cut to bring it down to 4.25% to 4.5%. Then thereafter, you have another 25 basis point cut to bring it down to 4% to 4.25 to 5% before 2024 ends. So that's in the 18th of December meeting. So it seems to me that market now is now looking for a potential 50 basis point cut instead of a 25 basis point cut in the 18th of September FOMC meeting. And right after the US presidential election on the 7th of November, a good chance of a 50 basis point cut as well, because it's rather quite high, it's about 46%. So it's 50-50, either a 25 basis point cut or a straight away a direct 50 basis point cut to bring it down to 4.25% to 4.5% in the 7th of November 2024 FOMC meeting. So what we could see right now is that market is now looking for a panic cut by the Fed. So this panic cut by the Fed, right, does it looks good for the US economy? Yes, for the US economy, yes, potentially it looks good. Why? Because it will add on more liquidity into the economy from a fundamental perspective. But from a price action perspective or a global financial market perspective, does it look good? Unfortunately, the answer is no, because market tends to behave forward-looking, and sometimes they tend to behave it's an irrational way of looking at things. So if the Fed will indeed starts to cut more, that means by 50 basis point, it tells us that something is not right in the US economy. It could create more fear into the financial market, and given the fact that this time round in the last 3 to 4 months back, we know that the market is being driven by lofty valuation, especially on the global mega cap technology stock driven by AI, where we start to see Nvidia rising more than 100% year to date since the start of this year until before the corrective move took shape about 4 to 5 weeks back. It could create a what I call elevator down scenario. All right, so how do we look at things from this perspective is that, let me share with you one particular we call it a table. Okay, so this table, right, is one of my major risk concern, where I share in my at the start of this year in my 2024 global markets outlook, where I share with a wider audience in January. And for those who came to our premium event, one of our lunar Chinese New Year dinner, the Lohe dinner, I also do share this table as well for those who actually could recall. But for those who are seeing the first time, not to worry, this is something that I want to share right now because it's happening right now under our nose. It's one of the major risks that where the Fed pivot during recession, which is potentially right now that we may start to be in the high odds of already a hard landing or a recessionary scenario in the US economy, as explained in earlier on in my daily dose today because of the latest weak fundamental data coming out from the last Friday non-farm payroll data. Okay, so since November 1957, that's way back, the Fed actually pivoted 8 times during recessionary period. That means they start from a hard, initially they were hiking and they do a cut, okay, a cut, all right? So during this 8 pivot over here, which is yes, 1, 2, 3, 4, 5, 6, 7, 8. So there are 8 Fed pivot during recessionary period. So firstly, November 1957, May 1960, October 1969, October 1976, May 1980, August 1981, January 2011, September 2007, and August 2019. No, sorry, August 2019, no, it's September 2007. Pardon me, September 2007, because October 2019, during that time, there's no recession yet when the Fed actually pivoted during October 2019. Okay, so during this 8 Fed recession pivot that occurred during this recession period since 1957, the S&P fared the worst during these pivot months, okay, of October 1969. All of them are actually in the red. 6 months before, 3 months before the pivot, and 3 months after the pivot, 6 months after the pivot, and 12 months after the pivot. All of them are actually on the average, they actually fare pretty much badly. All right. And also January 2001 as well. So that was right after the dot-com bubble crash in March 2000 on the Nasdaq 100. So across the board, we see 6 months before the pivot, 3 months before the pivot. That means 3 months, 6 months before the Fed actually cut rate, the market actually came down first, and thereafter, even though after the Fed starting its pivot to cut rates, the market 3 months after, 6 months after, and 12 months after also fare the worst. Okay, pretty much badly, all in the red. And as well as September 2007. All right, it's only that 6 months before the market actually positive, but 3 months before it actually turned negative of negative 3.7%, and 3 months after it's actually down negative 6, and 6 months and 12 months after it fared pretty much worse, negative 13, negative 24%. All right, so we have 1, 2, 3. Okay, 3 months or 3 episodes that when the Fed pivot during a recession that has already been taken shape, the S&P 500 didn't actually fare very well. From 6 months before, 3 months before, and even 3 months after, and 6 months after, and 12 months after. Okay, the only instant over here is this one here is pretty much mixed in terms of the 1981 pivot, where the US economy is also in recession already. During the 6 months before and 3 months before and 3 months after, not so bad. Okay, positive 1%, negative 1.5% 3 months before, and 3 months after it managed to gain positive 2.9%. But after the long-term perspective, 6 months after and 12 months after, it actually went in the rate of negative 8%, negative 3% approximately. The only exceptional case was during the November 1957 and May 1960 pivot at that point in time. So during this point in time over here, we see a very disastrous performance on the S&P 6 months before and 3 months before and 3 months after the pivot. But 6 months after the first rate cut in November 1957 and May 1960, the S&P managed to have a positive gain of around 6% and 2%, but its performance starts to grow stronger 12 months after the first rate cut. That was, it managed to gain by 26%, followed by 14%. So the only exceptional case was during November 57 and May 60 during this when the Fed pivoted during these two recession period. But almost all the other we call it 6 Fed pivot during prior recession period. That means, i.e., the US economy has already been a recession. That means the Fed is late in the game. The S&P 500 starts to show very lackluster to negative performance before and after the pivot. So in terms of probability, it seems to us that if the Fed were to engineer the first rate cut where the US economy already slipped into the recession, it may not bode well for the US stock market based on the statistics that I share with you on your screen right now. And we know that US stock market is still the #1 leading market in the world. That means whatever happened in the US market, it will have a major cascading impact to the rest of the world. All right, so i.e., if this scenario starts to play out again, the rest of the world global stock indices could potentially starts to face this medium-term corrective down move as well, based on the previous stats where the Fed is late in the game and they pivoted when the US recession or US hard landing has already been underway in terms of enacting their first interest rate cut. All right, so this is something I want to share with you all. Okay, so we know that this is from a fundamental perspective. How about from a intermarket perspective? So based on the intermarket perspective, I want to share with you this particular chart over here again. So this chart I shared on last Friday, just have a recap of what happened on again. All right, so this was during the dot-com bubble, so it's a bit of the same analogy that we are seeing right now. Prior to the dot-com bubble peak in March 2000, we start to see a strong outperformance in the 1.5 year or so, but in the Nasdaq 100, driven by a team play of Internet 1.0. The current analogy right now is the team play on AI optimism. Why? Because AI in the long run will be able to improve profit margins of company that embraces it because of higher productivity. Yes, it's true. But once market get over optimism of it, it will drive valuation way above its realization point. That means it may not realization in the near future, but market believe that it will realize this high productivity gain 1 month or 1 year down the 6 months or 1 year down the road. That's why it drives the prices to a peak. All right. So what we could see over here is that both the Nasdaq and the S&P peak at the same time. All right, at the same time in March 2000. Okay, so this peak at the same time over here, we see the 10-year and the 2-year spread. After that starts to slope upwards. Okay, this is what I call the bull steepening. So this bull steepening is being led by the US Fed funds rate cutting. Okay, so there was a cut that took shape in December 2000. Okay, the first cut, then thereafter the Fed cut will cut aggressively, and the bull steepening of the yield curve starts to steepen much further. That means the 2-year dropping faster than the 10-year. So in this bull steepening phase over here, you realize that the Nasdaq 100 continues to drop, the S&P drop as well, but at a lesser magnitude. But the Dow Jones Industrial Average and the Russell 2000 try to trade sideways and attempt to shape a retest close to its December 1990, December 1999 and March 2000 peak high. It attempt to do a retest at that number. So it kind of trade sideways first for a couple of months over here after the first Fed cut. That means it traded for sideways 1, 2, 3, 4, 5, 6, around 7 months. So attempt to retest the March, what you call it, the December 1999, March 2000 peak area over here. But whereas the Nasdaq 100 continues to slide and the S&P continues to slide. So by the time the US economy already in a recession in February 2001, and the recession lasted all the way up to December 2001 over here by this, we call it hot shape thing. This is a recession period. So during this recession period over here, because the US economy has already been in a recession while the Fed embark on this interest rate cut cycle, it causes the Dow Jones and the Russell 2000, yes, they outperform the SPX and the Nasdaq 100, but they cannot shape a brand new all-time high. And thereafter, it continues to tumble along with the S&P 500 as well, okay, before hitting a low of March 2003. That, okay, so what we could see over here is that potentially this kind of scenario may be taking shape on the US stock market right now, because the Fed cut too late, and the benefit of this bull curve steepening may not be able to fulfill its positive feedback loop towards the Nasdaq 100 and the Russell 2000 for them to able to have a positive outperformance against the S&P and the Nasdaq 100. That means, i.e., they could start to trade sideways, which is considered as outperformance as well, or they could fall at a lower pace compared to the S&P and the Nasdaq 100 is considered as outperformance, but not a positive outperformance to see a brand new higher peak. Right, so this is something I want to stress for you right now, okay? And right now, something happening on the S&P 500 as well is this particular chart over here, which I want to share with you. I think, where is this chart? Okay, it's the same chart here, pardon me. Yes, this is the chart, okay? So this is a chart where I plot the ratio of consumer discretionary sector of the S&P 500 versus the consumer stable sector of the S&P 500. Both of them are equal weight. That means you know that consumer discretionary, the biggest weightage is Amazon inside. So I actually reduces Amazon weight by having all the consumer discretionary component stock all equal weight. So we do not buy skewed by a mega cap stock. Similar for the consumer staples as well. And what you see, this is a weekly chart of the S&P 500. And last week, it triggered a bearish signal on this ratio. That means the consumer discretionary divided by the consumer staples has a bearish breakdown below this major ascending trend line that was triggered yesterday. And what we could see over here is that prior triggered, okay, pardon me, prior bearish trigger of this trend line breakdown of this ratio lead to a significant corrective movement on the S&P 500. So that was previously in 18 January 2022 all the way down to the week of 10th of October 2022, the S&P fall by 19%. And during this period in time as well, okay, this was prior to the pandemic crash, all right, where the ratio also triggered that bearish condition. Then thereafter, the S&P 500 triggered a corrective move of negative 23%. So what it means that over here, based on this intermarket dynamics movement on the bearish condition that is being triggered by the consumer discretionary ratio against the consumer staples, potentially we may start to see a much more deeper corrective move on the S&P 500, at least from a multi-week perspective, to retest the 20-day, or no, the 200-day moving average, pardon me, at around 4,960 level, which was also close to the prior major peak over here that was formed in December 2021. Okay, this region here, 4,960, 4,830. Okay, so if you were to look at from this perspective over here, and we do the potential fall from the current closing price on last Friday, because this is where the condition actually triggered by the ratio. Okay, we put it downwards. Okay, so it's around 9.5%, close to 10%. So that's a very, very halfway mark of what we see previously on that previous significant corrective decline, once that ratio actually triggered a bearish condition in the past two we call it period over here. Okay, so in terms of fundamental speaking, why this ratio actually triggered a crash on the S&P in the past is actually the behavior of market participants, where we know that consumer discretionary tends to be risk-taking behavior. Consumer staples is a defensive. So what we could see over here is that if there is a unwinding of risk-taking behavior, that means previously there was what I call a crowding into the consumer discretionary sector, and market participant starts to allocate away from this particular sector and push it down more to the consumer staples. That means, i.e., this ratio starts to turn downwards. It could create also a negative feedback loop into the overall market, because market participant is now having a defensive stance. So everything has a kind of a psychological feedback loop, but this time around is the psychological feedback loop on the downside instead of the upside, because of a change in market psychological behavior from risk taking to a defensive stance. All right, so this is the current intermarket condition I share with you on the FX market. The next one I want to share with you will be more on the okay, pardon me. That is the current intermarket condition I want to share with you on the stock market. Okay, so now I want to share with you the intermarket condition or intermarket dynamics that is playing out in the FX market. All right, so on the FX market over here, I want to share with you, we know that at this point in time, the yen starts to strengthen very drastically. The yen, this dollar yen over here. So a lot of people try to actually, this dollar yen, is this the bottom? Because it already fall by a fair bit since 1.5 weeks ago. So if you look at the longer term trend over here, that means on this particular chart, okay, where is it now? Yeah, this chart. Okay, so what I do over here is I plotted a monthly chart. Is a equal weighted basket of yen crosses against the major currency, quite the G10 currency. That means, look at the way that is a carry trade basket. That means we talk about Aussie yen, Kiwi yen, CAD yen, SEC yen, Norwegian yen, Euro yen, Sterling yen, Swiss yen, and dollar yen. All of them has equal weighted. And if you look at this chart over here, right, this is a monthly chart. What we could see over here is that this previous push up to previous peak of July 2007. So this is where we start to see the very sharp move down in the yen crosses due to the, we call it the great financial crisis. And what we are seeing right now, this particular move over here is considered as a failure breakout as well. Okay, failure breakout, and price action reintegrate back into this level over here. That means it can't break above and it break down, and also below the 200-day moving average. And what we could see over here right now, it actually happened previously in the past as well. Over here, right? Previously, price action tried this level here. It break out. Then thereafter, it created this failure breakout as well. Okay, during this January 2008, after creating a peak in June 2007. Okay, so what we are seeing over here now is a similar price action that is taking shape again. And prior to this price action over here, then that lead to this drastic fall in the yen cross. We see the breakdown on the RSI as well after hitting the overbought level. And what we are seeing right now is also a similar price action behavior, where the RSI starts to break down as well after hitting the overbought level. That means, i.e., what we are seeing now, the drastic fall in the dollar yen may not be a major bottoming formation. And in fact, if you look at the longer term chart of the yen crosses, not even dollar yen, I look into the yen crosses across the board, including Aussie, Kiwi, and the rest of the other major currency, is telling us that potentially there must be more weakness ahead going forward. That means, i.e., you could start to see much more massive unwinding of yen crosses that was previously on the long side of the story. So what is taking shape in the marketplace right now, potentially there could be something that is pretty much drastic, that is unearthing in the market, that we do not know what is breaking in the market. So potentially there could be, fundamentally, there could be some shadow banking that is at risk right now, because we know that traditionally after the great financial crisis, more banks got to have more capital to actually safeguard any we call it great financial crisis from happening again. But potentially right now, this shadow banking risk could come in the form from the private equity sector. So we know that in the last 1.5 years ago, private equity is one of the hottest asset class to own because of that we call it that credit lending in private equity, where private equity funds actually has more firepower to loan up to this we call it credit lending instead via this company obtaining loans from private equity funds rather than obtaining loans from the banks, because we know that the banks are being we call it guarded by this we call it capital restraint due to the policy that is being implemented during the great financial crisis. Okay, so this is something to be aware of. All right, so today's a bit long because of the intermarket dynamics, because I want to share with you all there are a lot of significant moving parts that are moving in the market right now, and things doesn't seems to be pointing on the bright side of the story. That means potentially we may start to see more potential medium-term risk of movement in the market that could take shape from a multi-week perspective and perhaps stretching from a multi-month perspective as well right now, given the current price action that we're seeing right now from a intermarket dynamics. All right, so today is a bit long. Now let us now straight away jump straight to the intraday technical outlook, which is much more shorter term in nature. But before that, let me expand my screen so that you guys could see the levels much more clearer. Okay, so the first one I'm going to share with you all will be on the European currency. So starting with the FX market. So the FX market over here on the euro dollar. So euro dollar last Friday, we actually attempting the euro dollar to actually pierce down lower, but it didn't pierce down lower, and price action of the euro dollar just give a squeeze up over here. So we got to respect this squeeze up over here. That means i.e. Dollar weakness against the euro coming back into the picture. So given that the hourly RSI is now at the extreme overbought level, but there's no bearish divergence, so potentially we may start to see a minor pullback taking shape first. So first minor pullback support level to watch will be at the 1.0895 level. Next level 1.0870. So this level also correspond to two key technical elements: the former congestion area of this 25th of July and 29th of July now turns into a pullback support level, and also correspond to the 20-day moving average acting as a support level as well. So as long as this minor pullback didn't surpass 1.0870 level, we will flip to a bullish bias intraday on the euro dollar. First resistance to watch will be at 1.0950/1.0960, which is correspond to the 0.618 Fibo extension level that I drew from the low of 26th of June. And as well as it also correspond to this medium term descending channel, the medium term symmetrical triangle resistance that I drew from the high of 19th of July 2023 high over here. So but however, if we start to see a bullish breakout above 1.0950/960, then we will start to see a very substantial medium-term bullish breakout scenario unfolding for the euro dollar to expose the next near-term resistance in first step at 1.0990/1.010 figure level. Only hourly close below 1.0870 will invalidate today's intraday bullish bias on the euro dollar to see it sliding further down towards 1.0840. Below it exposes 1.0820 next, which also correspond to the 50 and the 200-day moving average acting as a support level, and as well as this pullback support level of this former minor descending trend line that I drew from the high of 17th of July. This line here in dotted gray now turns into a pullback support level, and if you do the Fibo retracement of the entire push up from last Friday, it also correspond to the 76.4% Fibonacci retracement level as well. Okay, that's for the euro dollar. Sterling dollar. So sterling dollar, initially we were bearish as well, almost hit the first support level at 1.27 figure level. So this was during the start of the European session. Then thereafter, upon the release of the non-farm payroll, it just spiked up and hit the first resistance that we highlighted. So clearly breaking up above the pivotal resistance that we have as well at 1.2750 level. So right now it's actually trading very close. During the Asia session, it did a pullback, and it's now trading very close to the 50 level mark as well over here. Okay, so this is the first support level to watch, okay, at 1.2780. So as long as this is a bit tight, so as long as it didn't break below 1.2735. So what's 1.2735? If you do the Fibo retracement of the entire push up from last Friday, it corresponds to the 76.4 Fibo retracement as well. So as long as this minor pullback didn't actually surpass below 1.2735, we'll flip to a short-term intraday bullish bias on the sterling dollar. First resistance level to watch will be last Friday minus swing high that was rejected on last Friday. Also this former congestion cluster area here from 31st of July at 1.2830. Above it exposes the 20-day moving average acting as a resistance at 1.2890 for the sterling dollar. However, if price action starts to break down below 1.2735, then this short-term intraday bullish bias for today will be invalidated for the sterling dollar to see another corrective down move to expose 1.270 figure level. Below it sees 1.2620, 1.2640 next, which is also correspond to the 200-day moving average acting as a support level, and also the minor swing low of 21st of June all the way up to 2nd of July. So that's for the sterling dollar. So now what we are seeing over here is that we have the dollar. Okay, now moving on, next will be the dollar against the Asia Pacific currency. So what we are having right now over here, starting with the Aussie dollar first. All right, so for the Aussie dollar over here, so for the Aussie dollar, where we are. Okay, yes. So the obvious order, no change. We'll still be using the 65.60 as my short-term pivotal resistance level. Still maintain that short-term intraday bearish bias in line with the intermarket dynamics that I shared with you earlier on. First support level to watch 64.65, followed by 64 figure level, which is close to the lower limit of this minor descending channel that is in place since 12th of July 2024 high. Only an hourly close above 65.60 will invalidate today's intraday bearish bias on the Aussie dollar to see a potential mini reversion rebound scenario to expose 65.80, 65.80, 66.10 in the first step. Above this level may take us higher to retest the 20-day and the 50-day moving average that is coming to act as a around a resistance level at this 66.45 level over here. Okay, so that's for the Aussie dollar. Very quickly on the dollar yen. So the dollar yen can't break above can't shape that desired we call it counter trend rebound at above 14850 level, that the short-term pivotal support level that we have, and instead it plunged all the way down and hit the alternative support level at 14460, which is right now. Currently the RSI is not showing any bullish divergence, so potentially it seems to me like it will be a potential falling knife again. So given that the RSI is at a grossly oversold level on an hourly basis, but there's no bullish divergence, we may see a bit of minor bounces here and there, okay, over here. So what I could do over here is that perhaps I will start, this is the Asia sessions, we call it opening. So I will use the Asia session opening here as my first resistance, minor resistance level to watch at 14630 for a potential bounce. So as long as this bounce didn't surpass last Friday breakdown level, which is now turned into a short-term pivotal resistance level at 14850. So as long as, so this 14850 also correspond to this dotted line here. So what is this dotted line? This dotted line, if you go to the daily chart, is in fact the major ascending channel support that was previously from the low of 16th of Jan 2023, now turns into a pullback support level, right? Pullback resistance level, not support level, pardon me. So previously this dotted line is a major ascending channel, now turns into a pullback support level. We also correspond to last Friday breakdown level at 14850, and also the pullback resistance of this former lower limit of this minor descending channel, indicating that price action is now decelerating to the downside. So as long as any potential minor bounce didn't surpass 14850, we will still maintain that we will flip to a short-term intraday bearish bias on the dollar yen Next near-term support level to watch 14340/14280, followed by 14160/14140 next, which is a Fibo cluster level. Only an hourly close above 14850, that means a price action close above 14850, then we will start to see a potential mean reversion rebound scenario taking shape in the first step to retest the 200-day moving average and the minor swing high area of 1st of August at 151 figures/15170 level. Okay, so that's for the FX market. Very quickly, let's now take a look at the major stock indices, starting with the Hong Kong 33. So Hong Kong 33, the Hang Seng Index, last Friday we have a bearish bias and hit the support level already on today's Asia session and managed to stage a bounce at this support level at 16,620. And also what we could see now is the hourly RSI has started to shape a bullish divergence as well. Okay, so with that, given that the rest of the markets are still falling, I don't have a very strong conviction that the Hong Kong 33 might shape a steeper so-called counter trend rebound scenario at this juncture. So a bit mixed element right now, taking into account of the intermarket dynamics that are play. So I will have a neutrality stance for today on the Hong Kong 33 or the Hang Seng Index. So neutral between 16,970 and 16,620. Only an hourly close above 16,970 could validate that potential mean reversion rebound on the Hong Kong 33 to retest 17,185, which is the 200-day moving average. Above it sees the 20-day moving average and as well as the minor swing high of 31st of January and 1st of August at 17,410 and 17,517 with the 20-day moving average acting as a resistance level as well. Now, moving on will be the Nikkei 225. So the Nikkei 225 continues to shape downwards over here. No clear continues to shape downwards, and most importantly, it's now broken below this medium-term ascending channel support level that I drew from the low of 3rd of January 2023. Okay, so with this major ascending channel support taken down on the downside, potentially we may see a further deceleration on the Nikkei 225 or the Japan 225. So last Friday we do have a first support level at around this 34,995, 34,600 or so, this level here, which is very close to the major ascending channel support. Since this major ascending support has been taken down over here, no clear signs of a bullish exhaustion at this juncture, so we will continue to maintain our bearish bias in short term for the Nikkei 225 or the Japan 225 using 34,995 for today, slightly above the major ascending channel, now turns to the pullback resistance level. Okay, this level here. So this level here will be my short-term pivotal resistance level, maintaining that short-term intraday bearish bias on the Japan 225. Next support level to watch the 32,910 level, followed by 32,500 and 32,220 level over here, this zone here. Then below it says 31,400. So 31,400, if you go to the daily time frame over here, okay, oops, okay, is this level here, this congestion area. Okay, so with that, only an hourly close, that means if the price action starts to move up and clear above 34,995, which is our short-term pivotal resistance for today, then this intraday bearish bias on the Japan 225, i.e. the Nikkei 225, will be invalidated to kickstart a mean reversion rebound scenario to expose the next near-term resistance level at 35,755, potentially also followed by 37,085, which correspond to the retest of the 200-day moving average. Okay, so that's for the Japan 225. Moving on, next will be the German 30. So the German 30 continues to plummet as expected and also hit below our support level that we have on last Friday bearish bias view. So right now it's actually a gap down during the Asia session, and right now it's resting exactly at a Fibo extension level of 1.618 and also close to the 200-day moving average that is acting as a support level at 17,445 and also very close to this minor swing low area of 19th of April as well. So with that, given that it's coming very close to a key support level that's being confluenced by three different elements, I will have a neutrality stance right now at this juncture. So neutral between last Friday US session high, which is at 17,730, and close to the 200-day moving average at 17,445. So neutral between these two levels, unless price action continues to break down once the European session open, and we will validate a further intraday bearish bias move on the German 30 to expose the next support level at 17,200. Let me put it in writing over here, 17,200. Okay, followed by 17,030 next. Okay, 030 next. Okay, these are the levels to watch. Now, what's up next for the major US stock indexes, starting with the US Wall Street 30, the Dow Jones Industrial Average. So the Dow Jones Industrial Average, last Friday, we were neutral because price action is coming very close to the 50-day moving average that is acting as a support around the 39,500 level. We are neutral between this level, that given that price action now during the Asia session has broken down below it, and there is no clear bullish divergence as well. Shape a lower low over here at this point in time. So what we could see over here is that potentially the RSI now starts to lift from the oversold region. So what we could see here is that potentially there could be some signs of a minor bounce here and there. Okay, so the first bounce level to watch out for will be today's Asia session gap down over here. Okay, this gap down area here. Okay, at 39,610 level. So as long as the bounce didn't surpass today's short-term pivotal resistance that I have at 39,845, which is this former minor swing low here of 25th of July that was taken out on the downside, it clashes. So this created last Friday trigger point of the steep down move. So indirectly, it could form a psychological barrier as well. So to prevent potential bulls from surpassing. So as long as the bulls can't surpass 39,845, the bias is still on the downside for the US Wall Street 30 in terms of the technical perspective. All right. So next support level to watch will be at 39,190, a crucial one. So this 39,190 is this medium-term ascending channel support from April 2024. A breakdown below 39,190 should potentially shape a much more deep, longer corrective, we call it decline. That means it could stretch from a multi-week perspective already to expose the next near-term support level in first step at 38,975, followed by 38,740 next, which is this minor swing low area of 18th of June. And as well close to the 1.618 FIBO extension as well. Only an hourly close back above 39,845. That means price action reintegrate back above 39,845. Then today's intraday bearish bias will be invalidated to see a much more pronounced mean reversion rebound scenario to retest 14,140. Followed by 40,380 near-term resistance level, which will correspond closely to the 20-day moving average as well, I think as a resistance area. Now, with that, let us move on to the Nasdaq 100. So Nasdaq 100 on last Friday, we were bearish and it hit the support level as expected, 18,240/400 level, which is also the, and price action in today's Asia session continued to decelerate lower and broke below the lower limit of this minor descending channel. Now turns into a pullback resistance, which is also the gap resistance that is being formed in today's Asia session. So using this gap resistance over here and the pullback resistance of this lower boundary of this descending channel. So if price action could continues to remain bearish on the intraday basis, it shouldn't surpass this gap area over here that is being formed during Asia session. 18,240/400 will be our short-term pivotal resistance for today. Still maintain that short-term intraday bearish bias on the Nasdaq 100. First support level to watch will be a crucial one, 17,790, which will correspond to the 200-day moving average. A breakdown below it potentially sees a further deceleration towards the next near-term support zone at 17,400/17,310 level. So you go back in time, it will be this congestion area here of 1st of May and 2nd of May. Okay. However, if price action starts to go up and reintegrate back above the gap down that was seen during today's Asia opening session at 18,400, that means hourly close above 18,400, then today's intraday bearish bias will be invalidated to kickstart a mean reversion rebound scenario to see the next resistance coming in first step at 19,230. Above it, may see 19,002, 19,002. So not 9,000. This will be 18 typo error. 18,680. Okay, so I repeat again, hourly close above 18,400 level will invalidate today's intraday bearish bias to see a mean reversion rebound scenario. Mean reversion rebound scenario, first resistance level to watch 18,680. Above it sees 19,230 next on the Nasdaq 100. Okay, so with that, sum up the intraday technical outlook on the major stock indices. Let us now focus on the commodities market. So the coin market, spot gold, XAU/USD first. So XAU/USD last Friday we were bullish. It's almost, it hit the resistance that we highlighted, 2,483. Printed almost a high of 2,477, give or take. It's almost there before it came down. And where it came down over here is that in today's Asia session, it attempted to actually do a sell-off, but this sell-off managed to help exactly at two key short-term technical elements. One will be the minor ascending channel support that I drew from the low of 26th of July, and also the rising 20-day moving average as well. All right, so it's a zone of 2,410, 2,400, and we start to see the RSI also bouncing off from a parallel ascending channel, ascending trend line as well. So with that, we'll still maintain that short-term intraday bullish bias on gold XAU/USD with an adjusted short-term pivotal support for today at 2,400. So it's a zone, the lower limit 2,400. So as long as 2,400 holds, still maintain that short-term intraday bullish bias. First resistance to watch 2,457, followed by 2,483 for today. Above 2,483, may see the next resistance coming in at 2,510 level, which is a brand new all-time high. So you do this brand new all-time high, you do the Fibo extension over here. Taking out it. Okay, it's also correspond to the 0.764 level. Okay, 0.764 extension, the fifth wave target. Okay, now, however, if price action starts to shape another push down and broke below 2,400 level, your hourly close below it, then this intraday bullish bias will be invalidated to kickstart another round of choppy corrective decline scenario to retest 2,377, which is close to the 50-day moving average. Below it may expose the swing low area of 26th of July that is acting as a support at 2,353 next. So that's for gold XAU/USD. Lastly will be West Texas crude oil. So West Texas crude oil, we were bearish on last Friday, and right now price action is now coming very close to 73.15 level, which is the symmetrical triangle support level that is in place since March 2023. All right, this medium-term symmetrical triangle support level. And very interestingly, on the hourly time frame, we will start to see a the RSI over here starts to shape a kind of a bullish divergence scenario where price action almost shape a similar low, where you could see over here from the low of Friday and today's Asia session low, same low, but the RSI is sloping upwards. So that's also considered a bullish divergence as well. Moving in opposite direction of the price action. So with that, using the lower limit of the symmetrical triangle that is support level at 73.15, so that will be my so-called short-term pivotal support for today, looking for a potential mean reversion rebound scenario to unfold on West Texas oil. First resistance to watch will be at 75.46. Above it, potentially exposes 77.22 next. Only a push down with an hourly close below 73.15 will invalidate today's intraday bearish, will invalidate today's intraday bullish bias to see the continuation of the mean reversion, to see the continuation of this intra impulsive down move to expose the next support level at 71.35, followed by 70.40 next. All right, so that's actually sum up the intraday technical outlook on the major cross asset classes. So before we go, what are the key economic data to look out for today? Okay, so for today, what we could see over here, let me open up the calendar again. Okay, so for today, we go all the way down for Monday. the key data to look out for will be the ISM services PMI data. Why is it important? Because this is considered as a leading economic indicator in the US. So like I explained earlier in my daily dose of market insights for today, there is a risk that the hard landing or recession scenario has already been in place in the US economy. And if this ISM service PMI data continues to plunge lower than expected, because market is expecting a 51 point increase from 48.8 that was printed in the month of June. So anything that's below 50 is a contractionary mode. And if the actual data came in below what is market expecting and worse still came in below 48.8, let's say around 47 to 45, it actually further increases the odds of a recessionary scenario that is now currently in process or undergoing in the US economy. And market will also be watching this employment subcomponent as well to see whether it continues to actually tumble below 46.1, so far indicating a further weakness in the US labor market. All right, so with that, that's sum up today's daily dose of market insight. It's a bit long. Why? Because it's very critical for today, because I need to share with you important things that is being unfolding in the market right now from a longer term perspective. All right, so with that, this is Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.